If you've built a small business and looming on the horizon is your exit plan, you might have considered transferring your business to your kids. But this is a big move and arguably one of the biggest moves you'll make in business. So here I'm going to give you a clear 5-step roadmap that I use with my clients in order to help them through this transition. And step number 1 is to start moving. The biggest mistake that business owners make in a decision like this is waiting too long. But effective succession planning usually needs a runway of about 3 to 5 years, ideally longer. Why so long? Because planning early gives you the power to maximize the value that everyone comes away with, slash your tax bill, and make sure you aren't making hurried decisions that will lead to regret later. But before you call your lawyers, there's something you need to do first. Talk to your kids. You need to figure out specifically how they're going to fit into the business. And there are 3 things that you need to know about your kids in order to make this work, especially if there's multiple kids involved. First, you need to figure out ownership. Is your child or children the type of person or people that can be a business owner and all of the things that come along with that? Number 2 is whether or not your children share in the same mission and values that you do. It's going to be really difficult for them to run something successfully unless they're fully bought into the mission and values that thing is built on. And finally, what skills do your children have and what skills need to be developed? The good news is that as a parent, you are probably the best person to gather and know that information, which will help you down the line as you need to make those decisions. Step number 2 is get an official business valuation. And I do not mean your best buddy's best guess. I mean a certified appraisal. This will give you an objective and justifiable number that you can use as the foundation of the rest of your plan going forward. But this number isn't enough actually, because if you're doing things right, you're probably starting several years in advance like we just talked about. So the actual transfer might be sometime in the future and your business might be worth something different by then. So you'll need to forecast the business growth over the next couple of years until the transfer date, because that might change the way that you want to structure this transfer. Now this number doesn't have to be 100% accurate because you are going to have to get another business valuation as you get closer to the transfer date, but it is a good number to keep in your back pocket as you make your plan now. Now, step 3 is planning out how you're actually going to transfer the business. There are a couple of different ways that you can do this. So the first is that you can have a straight up sale. Your kid or kids buy the business from you based on its valuation. They might use something like an SBA loan, or you could finance the deal yourself. However, it's important to know that the taxes for this transaction are going to come all at once, which might push you into a high tax bracket whether or not it's capital gains or its income. We'll revisit that in just a second. Another option is gifting. You could just gift the business to your kid or kids. Instead of doing it all at once, you might do it gradually. The IRS allows you to gift a certain amount every year tax-free. And you also have a very generous lifetime gift tax exemption, which in 2025 is $13.99 million. But Congress can change that in the future. But gifting shares over a few years is a good way to reduce or completely wipe out your tax liability. But this does have to be planned very carefully. And it all revolves around the commonly misunderstood gift tax. When you're born, the IRS gives you a lifetime estate tax exemption. Like I said before, as of recording this video, it's $13.99 million. This means that when you die, everything in your estate is tax-free up to $13.99 million. But the IRS also gives you an annual gift tax exemption. As of recording this video, it's $19,000 a year or $38,000 a year if you're gifting as a married couple. This means that you can give up to that number with no tax ramifications. But if you go over, the amount you go over by is subtracted from your lifetime estate/gift tax exemption. Since that was probably clear as mud, let me give you an example. Let's say I have $100,000 sitting in my bank account, and I want to give $100,000 to my son. So between my wife and I, we give our son $100,000, but all at once in the same year. Well, our gift tax exemption was $38,000, which we were over by $62,000. This means that $62,000 will be subtracted from our lifetime estate tax exemption. This is important to understand if you want to just give your kids your business, because you might have to strategically draw it out over a number of years if you don't want your kids footing a massive tax bill when you die. Third is the installment sale. This is kind of the best of both worlds. Your kids buy the business from you, but they pay you over a number of years and usually out of the company's profits. This is good for 2 reasons. One is that it gives you a steady stream of retirement income that isn't coming directly out of your kids' pockets, but just out of the company profits. And 2 is that it does spread out your tax liability over a number of years. The only catch with this is that your retirement is kind of tied to your kids' ability to run your business successfully. Each of these options has serious tax and legal differences. This is absolutely not a DIY project. The fee you pay a good lawyer, tax advisor, or financial planner is going to be a drop in the bucket compared to the money that you save. Now, let's talk about taxes for just a second. I've mentioned taxes several times, and it's one of the reasons outside help is absolutely necessary. There are a couple of types of taxation you might see in a transaction like this. The first is where the proceeds are taxed as income. This is the least optimal because income taxes are the highest kind of taxes that you can pay, but the good news is this isn't super common for the sale of a business. At least not on the whole thing. It's kind of complicated. But the second type of taxation that you might see is a capital gains tax. Capital gains tax is where you pay taxes on the difference between how much you bought a thing for and how much the thing is worth now, hence the word gain. Which taxes you end up paying depends on a lot of different factors and even the type of business structure that you have. And unfortunately, there's not enough time in the world for me to explain the nuances on that, which leads me to step 5. Like I said, this isn't a DIY project, so there are a couple of professionals that you absolutely want to include in order to get this thing done. First is a CPA or a tax advisor. They will help with the valuation, make sure everything is as tax efficient as possible, and they'll make sure that you're playing by all of the correct rules. Now, you do want someone with a CPA or an EA designation, and here's why. Those two kinds of professionals can legally represent you to the IRS if something were to go wrong. Most other tax professionals can't represent you to the IRS. All they can do is simply file your taxes for you. That's why those two designations are important in this case. The next person is an attorney. They are going to make sure that all of your documentation for your business, your personal finances, your will, your estate are all in agreement with one another and with no loopholes worked in. They will also be important if it comes to a point where you need a trust. All of these things are wrapped in legalese, and it's helpful to have a good attorney that can get all of this written out for you. The third person you'll want to include is a financial planner. They're going to help you see how this business transfer works into your big picture financial plan. Now, unlike the tax advisor that I mentioned earlier, a financial planner doesn't necessarily need a 3-letter designation after their name in order to be a good one, although it does help. But really what you need is somebody with a fiduciary responsibility. This means that in everything that they do with you, they need to be legally required to put your interests ahead of their own. This immediately rules out insurance salesmen and even a lot of advisors that work at big wirehouse firms. Now, I'm not going to pretend that I'm not biased here, but if you're going to do this, it's best to look for an independent RIA. The reason for this is obviously, yes, the fiduciary responsibility is there, but also usually independent RIAs are more focused on planning than they are on other things like portfolio management. Because a lot of them aren't paid for selling a product like a mutual fund or insurance policies, most of them are simply going to give you good advice when it comes to your big picture financial plan because that's how they get paid. So the idea is that when you hire a financial planner, the emphasis is on financial planning and not just portfolio management, although that might be included. Now, there is one aspect we haven't talked about. What if, for whatever reason, you don't want to include one of your children in your business? Maybe they don't want it, maybe you don't think it would be a good fit, or maybe one of your other kids just worked in the business for so long that you think that maybe they should be the ones rewarded with all of the equity. Whatever the case might be. Well, there are a couple of different ways to address this if you still want them to receive something when you die, even if it's not your business. The first way to tackle this is by using life insurance. You can take out a permanent policy on yourself where the value is similar to the valuation of your business, or at least worth a lot of money. And then you name your child that isn't going to receive your business as the beneficiary. So let's say that you have 2 kids, one that's getting your business and the other one that isn't. Well, one of the kids the business would be transferred to, and the other one, when you die, would receive the benefit of the life insurance policy that you had. Both people ended up with money at the end of the day, just one of them is not tied to carrying on that business that you built. But this could also be evened out with other assets like real estate or investment accounts. Ultimately, how you want to distribute your wealth and to whom is completely up to you. But there are ways to even things out monetarily if one child isn't continuing in your business. Planning to pass your business along to your kids is one of the most meaningful things that you can do as a business owner. But to get it right, you're going to have to be deliberate about the plan to get there. So if you're serious about protecting your legacy and building a business that will last generations, make sure to subscribe to the channel.